It's time for our deep dive. We're focused at number 5 on Deutsche Bank, outlining that new plan to cut nearly $4 billion in costs over 5 years. It's the biggest revamp since co-CEOs Juergen Fitschen and Anshu Jain took the helm 3 years ago of Germany's biggest bank. Bloomberg's Hans spoke with Jain earlier this morning. He was optimistic, as you might expect, about the bank's future.
You will see us stronger in equities than we are today, building on the momentum we've had over the last 2 years. You will see us considerably stronger in corporate finance than we are today. You'll probably see us a smaller flow fixed income house. You will see us less transactional and more advisory.
All right, well, for more perspective, I want to bring in Allison Williams. She's the senior analyst with Bloomberg Intelligence who focuses on the banks. And Allison, look, you know, we see the CEOs, they're saying that they're setting up Deutsche Bank for a stronger future. But we saw from the share price, I mean, down over 4%. Investors are skeptical about this, right? So what are they most skeptical about?
Well, I think investors like the targets. I just think that we need a little bit more detail on how they're going to get there. What is the execution? So we're talking about a very long time frame, right? Strategy 2020, a 5-year time frame. They outline the costs that they want to cut, but not how they're going to get there. And I think that's really what investors want a little bit more detail on.
Okay, and I mean, what's the speculation here? I mean, what could the details be? How could they possibly get to the $4.5 billion in cuts they're talking about?
Well, I think they've given, so they've given sort of the broad strokes of their strategy, and they've talked about how they're, the businesses that they're going to scale back, they're going to cut leverage in the investment bank, and they're going to be, investing in asset and wealth management. This is a theme that we've seen across the major European investment banks. But, the $3.5 billion of cost cuts that they're aiming towards, where are they going to be? Specifically, how are you going to get those costs out? How are you going to become more efficient? When JP Morgan earlier this year announced costs in their investment bank, they basically said, here are the costs, and we've already identified ways that we're going to get there.
So they've laid it out already. So,
right.
So would you say that they seemed unprepared then, or they just don't want to reveal these details?
Well, I think it's a sort of a broad strategy, and they're sort of just thinking like, this is the target, this is what we want to achieve. So I don't think
they'll back into it,
right? And so I think they need to figure out how they're going to get there. And I think, from an investor standpoint, a year ago we had certain targets laid out. And, a year later, here we are with a new strategy shift.
Yeah.
And the cost cuts are part of it, but really getting to the higher leverage ratio is what's important and one of the key things that investors are focusing on, and investors want to see how they're going to do that.
Well, Anshu Jain talked a little bit about the legal settlements, with the $2.5 billion LIBOR settlement and capital increases. So let's just quickly play that. I want to get your reaction.
We are completely fine, and we will be able to sustain and maintain our capital ratios despite that. As we've demonstrated in the first quarter, Hans, let me point out, yes, we took that $2.5 billion charge, and as you know, this morning we've reported a very solid quarter with strong operating results.
So categorically, no capital increase, no need because of litigation challenges?
Categorically, no capital increase.
No capital increase. What about further legal settlements here?
Well, I think legal settlements do continue to be an overhang for all of the global investment banks, and I think that's another thing that we're seeing in terms of looking at the company's capital targets. So there are two different targets. One is the leverage ratio. The other one is a ratio that's based on risk-weighted assets. And I think that investors are surprised that the risk-weighted asset ratio and their targets seem to imply that there is going to be a step up in risk-weighted assets, higher operational risk, likely driven by the legal.
All right. Allison, thank you so much. Allison Williams of Bloomberg Intelligence on bank.